Okay, good afternoon, ladies and gentlemen, and welcome to the next installment in the Admiral Markets Trading Spotlight webinar series. My name's Paul, and I'm here today to talk about what should you trade, Forex or stocks. Fascinating subject. We could talk about this all week, but we only have the next 40 minutes or so to go through, which will be plenty to get us started. And as always, I appreciate we always have a real wide spectrum. Okay, here joining us for our sessions. So I appreciate that some people who've been trading for 2 weeks, some people have been trading for 2 decades. So it always helps to sort of try and understand, the audience we're talking with. So if you've got an opinion, or if you trade one or the other, maybe you trade both asset classes, would be fantastic if you just put it there in the chat box, or if you're watching this on demand on the Admiral Markets YouTube channel, just put it there in the comments if you find it useful. Give us a like. Okay, it is an interesting subject, and it is very relevant based upon where we are today in the world and what's been going on. And as always, I speak for Admiral Markets here, that it's great for you to join us, and we hope that wherever you are in the world, when you're watching this, joining us, we hope you and your family are safe and well, and making the best of what is a rather tumultuous 2020. And we really thank you for being here with us to help guide you on your own trading journey. So what we're going to talk about today in terms of, which one you should trade, well, we'll talk about, how does a trader understand which asset class to trade, okay? And we'll talk about what should a trader be aware of before making the choice, and how does a trader engage with these asset classes. And that's something that was actually more useful if you stay with us till the end. Then I'll switch across to the live charts on the Admiral Markets MT4 platform, and we'll actually take a look at both of the asset classes and try and help give you a little bit of insight and understanding. For those who don't know, my name is Paul. I've traded for many years and coached traders for many years as well. And primarily, I like to trade FX indices and commodities, and primarily for kind of my swing trades, position trades, I'm a trend trader. And for my intraday trades, I'm more of a mean reversion and reversal trader. And here with Admiral Markets, as you can see there, Admiral Markets provide a wide range of instruments that you can trade with a real kind of global reach. They're licensed and regulated across a wide range of regulatory environments, providing very competitive spreads for the most popular trading products, and allowing you to engage with markets using both MT4, MT5, and their own Admiral Markets Supreme Edition. If you have any questions about Admiral Markets, please get in touch with your account representative, and they'll be very, very happy to guide you. So, as I said, we're here to trade about what should you trade, Forex or stocks. And, there's a few comments here there. Okay, great to see you again, Opera and Michaela. Thanks for joining us. Ronald says, I trade them both, but usually stocks more. Be interested to understand why you do that, Ronald. Michaela says, trade mostly in stock, CFD, and long-term holdings. Very new to Forex and wish to learn more on Forex specifically. Well, hopefully we'll touch on a little bit here today that Michaela, that might actually help you, just give you a little bit of additional insight. Opera says I don't trade stocks. Well, maybe you'll have some food for thought here, okay, after the end of our session. But it is a kind of an interesting conundrum, should we say, for you, ladies and gentlemen. And as the slide says, that there are times when new traders are left wondering whether they're trading the correct instruments. They're trading FX, and then all the moves appear to be in the stock markets or in the equity indices, or they're trading crypto, but all the moves are happening in the FX market. Okay, so especially if you're new and you don't fully understand how the markets are moving, in particular money flows and order flows, that can lead to confusion, and also traders end up making quite impulsive, knee-jerk decisions to chase a moving market. And this is a move that rarely ends well. So today we'll look at both the Forex and stock markets in order to help you decide which one you should trade. But I'm also going to talk about one particular aspect that might help you in understanding not only FX markets, but generally markets in a kind of a wider understanding that might just help build your picture, okay, add a little bit of color to your landscape as you start to understand the difference in those particular markets. And it is very true what I say there in the stocks is that when you're a new trader, it becomes very challenging, okay, because you might be trying to focus on FX, but all the moves are happening in the stock market, or you're focusing on crypto and actually the moves are happening in FX, and it can seem like you just end up chasing your tail, okay, and just chasing the moving market. So let me give you a bit of free advice, ladies and gentlemen. Don't. All right, don't do that. Don't be chasing your tail, chasing the next move. Okay, it rarely ends well. Okay, it rarely ends well. Better to pick, one, maybe two asset classes that you can start to focus on, and get good at focusing on one particular asset class. Okay, and actually start to understand that. And then as you gain an experience, well, then perhaps you can sort of add additional asset classes as you go. But just basically chasing the moves, that rarely ends well, ladies and gentlemen. Okay, you might get lucky once or twice, but it won't work longer term. I can assure you about that, and that's what we're trying to do here to sort of help guide you, sort of from to help you with your own trading journey. So Ria says, I trade stocks, but I want to learn more about Forex. There'll be an element of that here for you today, Ria. Eva says, I'm a new trader wishing to trade FX. Okay, good. Well, that's great. We really enjoy the interaction. It helps me as well to know who we are in the audience and actually, where people are. As I said, there's always a wide range of experience in the room, and it helps me to basically try and give you as much useful information as I can within the time we have allocated. So, as it says that there are times of the year when you can focus on one asset class over the others, perhaps FX, perhaps stocks. Others might say, you want to focus on commodities, okay, or crypto, okay, or equity indices, all right, that's fine. But they're outside the scope of what we really want to focus on today. We want to really make a decision on, should we be trading on FX or should we be trading stocks? I wish I could give you an absolute clear cut, okay, unambiguous, sort of set of rules on when you should be focusing on one over other, okay? Something, a nice simple adage like, only trade stocks in October, January, March, and April, okay? Something that was very, very simple that gave you a real clear understanding. Sadly, I'm not able to. Okay, and you'd find most traders would not be able to tell you. Sometimes it's very clear. Okay, sometimes it's very clear where the kind of action is in terms of where the kind of money flow, the order flow is happening, and that can be very clear because you're seeing very, very clear trends, and there is also the kind of those 4Ms, okay, of markets which I hear me talking about, namely the kind of the markets, the method, the money, and myself. They're all in alignment, okay? So, a part of that is understanding maybe the sort of the sentiment, okay? Just by being able to see where a kind of the news flow is also, focusing, right? So where that is focusing, that can sometimes give you a little bit of a hint if the news flow is also giving you following through in terms of the price action that you see in markets. So, as I said, sometimes it'll be very clear, other times it will not be, okay? And that's welcome to trading, ladies and gentlemen. Sometimes it's very clear, sometimes it's not. And the truth is, with a little bit of experience and understanding with what we're going to share with you today, that helps you start to sort of gain a better judgment about when it is you should be focusing on one of those particular asset classes. As I said, it depends on your experience as a trader. Newer traders are better to focus on one area as they learn their trade. And that is actually very true. And we're going to talk a little bit about that today, okay? I appreciate we've got lots of newer traders joining us, trying to grasp and understand, okay, the complexities of the market and seeing how they can find it, just make it a little bit more simple, a little bit more congruous in terms of the way they act and engage with those particular markets. So with that in mind, let's start with a little economics 101, all right? So I don't consider myself to be, an economist. I'm a trader, but it helps us to understand maybe a bigger picture, and from which down we can start to sort of boil it down into where we should particularly focus. And as I said, for those of you who just made comments there in the chat box, if you've particularly chosen one asset class over another, I'd be fascinated to understand why. What was it that drove you to trading FX? What was it that drove you towards trading stocks? Okay, it's just I find it fascinating because people have lots of different reasons for operating the way they do, and it always helps to understand what was the side of kind of the drivers underneath those particular decisions. So as I said, let's just do a little bit of very, very basic, brief, big picture economics 101. I think it's generally accepted that we find ourselves in a low interest rate market environment, and that has consequences for traders. What we have seen really since the last financial crash in 2008 is that, and some might say even earlier than that, maybe, even sort of end of the 90s into sort of after 9/11, is that central banks and government interventions have skewed markets, okay? created money out of nothing, shoved it into the stock markets, okay, and that has basically had knock-on impacts, all right, and consequences, which we will come back to. And what that means is that it means people will try and trade and invest as they get no interest in their bank account, okay? If your money's sat in the bank and it's getting probably, I don't know, 0.01%, all right, okay, or something like that, at best maybe 1%, well, then people need to try and get a return on the money, because otherwise, okay, that money is just eaten away by, inflation. Even though we believe inflation, even though the kind of prescribed and the kind of formal inflation is low, we all know that it's a little bit higher than that, and that eats into just money sat in your bank account. And that's part of the idea, is by doing that, central banks, governments are trying to push people to basically take money out of their bank accounts and actually utilize it in the economy, whether that be buying stuff in the everyday to day economy, or basically people putting money into investments to keep stock markets afloat. And that has had the effect, especially here in 2020, of helping at times to help surge stock markets, okay, because those markets are awash with money, okay, that money needs a place to go, and we find that money just basically finding its way into stock markets, and in particular US stock markets, and we have covered US stock markets and tech sectors in some of our previous Trading Spotlight webinars. As always, I'd suggest that you just go and find them. They will be on the YouTube channel or on the Facebook page. Go and find them, okay, take a look at them, watch them, and help you just build your picture and understanding and education of these particular ways of operating. And the question has become, as that money has surged into stock markets, which we'll look at a little later on when we switch to live charts. Question is, are they viable trading and investing opportunities for new traders? All right. And how do those stock markets stack up against FX markets? Now, we're going to have a little look at that. All right. Let's have a little look about FX versus stock markets. And all I would caveat it with is that, today what we're looking to do is that, to give new traders an understanding, okay, of the dynamics of those two asset classes and elements that you need to take on board in terms of, raising your awareness so you can make better informed choices about where you should focus your time, energy, and resources. Some more, let's say, very experienced traders might differ in their view, but I would just say, as I said, we're just looking to try and help newer traders get a little bit of a better understanding of where they can put their particular focus. So, all right, so what should you trade, Forex or stocks? Now, this is my interpretation, okay? Some people might differ. You might have a different view yourself. That's absolutely brilliant. If you do have a different view or a thought on it, please put it in the chat box. Or if you're watching this on demand later on the YouTube channel and you have a different view or have a different idea on it, please stick it in the comment box. We always make sure that we answer your comments. We actually love the interaction, and we're very happy to help, guide you wherever we possibly can. Let's look at stocks first, okay? Because I appreciate lots of people, would be used to trading FX, but let's have a little look at stocks, okay? In my opinion, okay, from my own experience and from working and teaching and coaching, lots of traders over the years, is that when it comes to stocks, okay, traders tend to have a much more narrow focus, all right, in terms of they generally tend to be looking at a smaller basket of instruments, okay. This might be able to be counted on one hand, okay. Some particular stock traders become very, very good at just trading one or two particular stocks, or maybe they'll look to trade a particular sector that is either one, there's lots of movement and volatility in there, or they may have a personal understanding or a personal connection to and feel that gives them an edge in that stock market. You'll also find that when it comes to stock market, lots of traders and analysts will focus on fundamental analysis, right? That will be their key driver as part of their decision-making framework. That's what will actually sort of they'll look to focus on. And that's absolutely no problem that at all, okay? I've said in many of my previous Trading Spotlight webinars is that, whether you want to use fundamental analysis, technical analysis, you want to use sentiment analysis, you want to use the tides, okay, the risings, the phases of the moon and the sun, it's an individual choice. All it is a simple, robust decision-making framework that allows you to make a decision. Am I going to be a buyer? Am I going to be a seller? Am I going to sit on my hands? That's it. Okay, that's it. We all, myself included, sometimes get caught up in the intricate details of it, but really, all we're looking for with our analysis is a way, is a framework that allows us to make a simple choice. That's it. But when it comes to stocks, many focus on fundamental analysis. Not everybody, but there will be an element of it. And so traders will look at elements within those stocks, things like debt levels, cash flows, earnings guidance. Okay. And when there's earnings season, that could definitely be one of the areas where people will focus on trading stocks when you get, especially for the US stocks, when they will go through particular phases of the year where there will be earnings season. Okay. And those are mostly American stocks they will print their earnings. Okay. And that can induce a great deal of kind of volatility within those particular individual stock markets. And that can be a time when to focus on particularly stock trading. In my experience, in my view, is that, stocks, okay, and trading stocks is a lot about information flow, right? And this is a personal opinion, this is where I think private independent traders sometimes, okay, have a challenge, because the truth of the matter is, as a private independent trader sat at home or in your office or wherever, just trading stock markets, the truth of the matter is, we're at the bottom end of that informational food chain. Okay, we are not the great white shark at the top of the information flow. We are the plankton at the bottom of that information food chain. Okay, and that's okay. It is what it is. And part about being a trader is recognizing and being aware of where you sit, okay, and being able to make better choices and decisions about where you should focus your time, energy, and resources. Also, another element of it to do with stocks is that stock price rises and falls can actually be determined by the sector and the overall index. So very often, and I would say it's somewhere quite often between like 50 to 80% of the time a move in a stock can actually be driven by what's going on in the greater sector and the overall index. So your particular stock that you focus on may have an earnings number, which is a good number, which helps. And you would expect actually, to have a really strong move there, okay, for that stock. But actually, the broader sector that day is bearish and the overall index is bearish. And so even though you've got great numbers and are expecting a great move, it's tempered by what is actually going on in the bigger sector and index. Okay. And when they're in alignment, fantastic. But when they're against, then you can have challenges. Okay. So you just need to be aware of that. So when I do that, replicating when I look at the FX markets, as a general view, whereas stocks is a very narrow focus, FX traders tend to have a bit more of a wider focus. That's not to say that they might focus on one or two particular FX pairs, but as a general rule, okay, they tend to have a wider focus because a currency reflects the aggregated performance of its whole economy. Therefore, okay, FX traders are more interested in macroeconomics, okay? Whereas a stock trader might be interested in the particular pieces of information relating to that one stock, FX traders generally, as a rule, they're looking at a much bigger picture, much broader picture, okay, both on a national basis, but also maybe a regional, and then also on a global basis. And this is where technical analysis may suit FX traders. There are plenty of FX traders who use fundamental analysis, but as a general rule, we can use technical analysis that will suit an FX trader. But as I said earlier, remember, all it is, don't get too caught up in needing to know every last little bit of detail and how to be a great technical analyst or a fundamental analyst. It is about a simple, robust decision-making framework that allows you to make a choice. Am I going to be a buyer? Am I going to be a seller, or am I going to sit in my hands? That's what we're trying to boil down to. So, an FX, trader might be looking at bigger numbers in terms of things like unemployment, inflation, gross domestic product, and also interest rates. Okay, interest rates are of an interest. They're very key in FX markets. Perhaps not as much as they were maybe 10 years ago when there was a much greater difference. Okay, certainly with the FX major pairs, and then we had elements of things like what we call the carry trade. Whereas today, as I said earlier, we're operating a very kind of low interest rate market environment. So the kind of differentials are nowhere near what they used to be like 10, 15 years ago. And you also have to consider that, when you place an FX trade, it is effectively you're trading two currencies at once. Okay, when you're trading, if you're going long pound against the US dollar, you're effectively buying the US dollar, thinking the British economy is stronger, and you're selling the US economy because you believe that actually is going to be weaker. So it is that case of understanding the bigger global macroeconomic themes that that do reflect in the way FX traders will make their trading decisions, especially for things like longer term trades. So, that's a bit of an insight into the difference between FX and stocks. But also we need to have a look at, well, what are the technical details, Paul? What are the difference? What do I need to be aware of on a day-to-day when I'm actually looking at how to focus on whether I should be focusing on FX or stocks? So once again, let's have a little look at the stock market, okay? Generally, stock markets are time limited. That is changing, okay? As I said, there's some exchanges have extended trading times. Some exchanges, okay, or the way you're trading, you might be trading an electronic contract, okay, that allows you to sort of trade on a 24-hour period. But generally, the vast majority of volume is traded on the particular stock market exchange times. Okay, so London FTSE would be like normally 8 a.m. to 4:30. Okay, that is the trending. Now, of course, you could trade it outside of that on electronic contracts, but the vast majority of the business is done within that kind of main, okay, stock market open times. Generally, okay, for certainly for, let's say, for retail traders, there's also smaller leverage available. Okay, much smaller leverage available if you're looking to trade stocks. You also will get some good liquidity in the major stocks, especially the major US stocks, okay? Especially, you might say, major US tech stocks, because they just attract an awful lot of interest. So you do get good liquidity in major stocks, okay? And that liquidity allows you to effectively to sort of, get your position on. That might not necessarily be of much concern to you if you're starting out as a private independent trader with a small account, but you do have to consider that, sort of major hedge funds, okay, major institutions, they're going to want to look to be able to sort of trade in stocks that actually have great liquidity. The problem is the smaller stocks, not so much in terms of liquidity, especially people who try to focus on trading like very, very small, kind of almost like penny stocks. The liquidity might be just so weak that you don't get out when you want to get out. You get out when you're allowed out, which doesn't always work in your favor. In fact, I'd say it rarely works in your favor. Okay, you just have to be aware of that. But what it does mean, with across those in the stock market, is that you generally will see wider spreads, especially considered to what you would trade on the major FX pairs. You're generally going to have wider spreads, okay, involved in trading particular stocks. And you also have to be aware that you'll have a commission normally on entry and exit as well. Okay, and these all need to be considered. It's your cost of business. You are running a trading business, and there are elements that you need to consider and take on board in terms of how you look to engage with markets. If we flip that as to how we look at the FX market, generally the FX market is a 24-hour market, okay, from opening in the Pacific, okay, in on what would be their Monday morning, but that's kind of Sunday evening here in Europe, running through to when the New York market closes, okay, at the will be 5 o'clock US time, okay, on a Friday evening, which can be about 9, 10, 11 o'clock here in Europe. But having said that, you are always able to do a trade during that work and week, and sometimes the Sundays based upon your particular geography. But there is still an element of understanding that there are major windows where the vast majority of, let's say, the kind of big institutional business would be done. London, okay, is still the kind of the main center for the world for FX trading, and so around that is when you're going to see huge amounts of the sort of kind of the tradable volume going through those markets, and then next into kind of the US session. But it's still, you are still able to trade through that Pacific session, and effectively you can almost kind of follow the sun in terms of the way you're trading your FX book. There's also kind of, compared to stocks, superior leverage offered for FX markets. Okay, now of course that has changed over the last couple of years as we've seen the ESMA regulations come in, but you're still normally able to sort of have superior leverage offered for FX. So normally for a kind of a retail trader, that's normally it's around I think around about 30 to 1, as opposed to maybe sometime between 10 to 20 to 1 for stock markets. You generally have superior liquidity. Okay, FX markets are still the kind of the biggest traded markets in the world. Depending upon the other kind of latest numbers, you can see between sort of kind of 5 to 6 trillion every day of FX flow, and that means that certainly as a private independent trader, your opportunities to basically to get in and out of markets should be very, very clear, especially if you're trading the majors. Maybe if you're trading some of the exotic miners and trading them at size, you might have a little bit of difficulty. But as a general rule, you should be okay to to get in with very limited to no kind of slippage. It also means, especially if you're trading those FX majors, that you generally have tighter spreads. Okay, and if you're looking at the very popular FX products, well, you can be looking to sort of half a pip to 1.5 pips. Okay, all right, so very, very small, very tight. And once again, it's all about your cost of business. You have that dealing cost is the spread, and you'd probably also be expected to have like overnight swaps, okay, which is effectively differences between interest rates and for holding positions overnight, depending on how you particularly trade your FX market. So there are differences there. Okay, there are particular differences there, and part of that, as I said, you're running a trading business, so you need to understand the implications they may have. To begin with, if you're a completely new trader, and you're trading at minimal size, they're probably not going to have a massive impact upon you. But it's something you need to have at the back of your head. If you're generating business, okay, you're building your business, and your position size will increase. Well, then invariably that will also have an impact in when things like you have spreads, overnight swaps, commissions, etc. You just have to be aware of that and take that on board. So, as I said, sometimes of the year, it can be quite easy to identify which is the better to trade, whether it be FX or stocks. Okay, if there is a clear trend in either your preferred FX or stock instruments. So, we're here. When I was doing this towards the sort of, we're into the kind of final calendar quarter of the year, and we've had quite a year in the stock market. Okay, the stock market has been fueled. Okay, and we're going to look at that. Okay, in a few slides' time, we'll actually switch across to look at it to get an idea. But generally, what I'm saying is, if you can identify a clear trend at on a kind of longer term time trend, then invariably that is giving you a hint that might be the opportunity where you might want to place your particular focus. For new traders, okay, normally suggesting that you want to try and be a trend trader. Okay, and it's about sort of just trying to understand where those trends may be occurring, whether they are occurring FX because there's some major geopolitical event or there's a sentiment shift, or it might well be that the stock market is because maybe that particular instrument is a bit of a darling of the news companies because of something they're developing at the moment. It's certainly something we have seen this year, and we'll look at that in particular when we switch across to the charts. The truth is, sometimes it can be very hard to identify whether you should be trading FX or stocks. So if you're struggling to identify it, the reason I tell you that is, well, don't be too hard on yourself. Okay, don't use it as a stick to beat yourself up with. There's no point there. There's nothing really to be gained from that, ladies and gentlemen. All right. So just a case of when it is very clear which one you should be focusing on, well, then that's great. When it isn't, that's okay. Don't be too hard on yourself. Okay, that happens to everybody. That is just, there are times of the year when actually markets are a little moribund. Okay, and it can be one or other, or it could be all of them. It could be just moribund. Okay, and we'll talk a little bit more about that in a moment to help give you a bit of understanding of the background. But don't be too hard on yourself. Okay. What can also help is to understand the overall way that markets tend to move and work on a yearly basis, and that can actually be very, very helpful. So with that in mind, why don't we take a little look at something called seasonality, okay, which can give you, as I say, just a little bit of the background, a bit of an understanding of things that you can take on board to help utilize, give yourself the sort of kind of the better understanding of where your focus particularly should be. So seasonality is the study of markets in relation to the time of year. So, for example, for stock markets, there used to, and it still is, there used to be a saying of sell in May and go away and don't return until post St. Leger's Day, okay? Which was effectively, if you're in the stock market, you sold that stock market in May, you went away for your summer holidays, and after you came back in early September, that is when people started to get interested in stock markets. And what that normally meant was that actually during that period of the summer, okay, is that, it usually led to a period of low volatility. Now, in many ways, that kind of, because we have, like, internet communications, global ability to trade at anywhere. Okay, that has taken the edge off that particular trading adage. But there is an element of, there are periods when we see low volatility, and by studying historical moves, it's easy to see that there are clear patterns of seasonality playing a part in markets. So we like to break up seasons in groups according to the following categories. So a low season, okay, would be from around May to August, and a high season from from September to April. And, as a master trader, it's imperative that you learn to identify these types of patterns in advance of trading. And you must learn the nuances and patterns of each currency pair, okay, that you plan to trade, and keep a log of this information, as it can be priceless when trading and when helping you make a decision on which particular asset class you want to be focusing on. So here's a chart, a daily chart of the British pound against the US dollar. Okay, and we just talked about periods of low season and periods of high season, and just take a look at that chart, ladies and gentlemen. Can you see any particular patterns there? Can you see any particular elements that might be of interest, or things that might actually occur or be relative to you in terms of deciding where you might be focusing your energy, whether it be an FX or whether it be in stocks? If you can see something, then just pop it up in the chat box there, okay? If you can see any particular idea or theme, that's what we're particularly just trying to understand and help give you a little bit of the background information to start sort of just seeing how you can actually make decisions on where you should be particularly focusing. So Nevin says that he can see a head and shoulders pattern. You might be able to see a head and shoulders pattern there. That there's quite a few particular trading patterns. What I'd kind of like to try and understand is perhaps the themes. Or are there any particular themes that we see between the high season and the low season? And Michaela says cashing in sells and buys on booms and falls. That's one way to look at it there, most definitely, Michaela. But what I want you to be able to understand, okay, is effectively let's just draw this tool out here, okay? So let's use my drawing tool. Here we are in high season here, and what can we see? Okay, what actually happens in that high season there? And then once we're back into this high season here, probably the next year, what can we see in that high season there? When we're in this particular low season, what do we actually see there? When we're in this low season, let me just move this around. What do we actually see there? When we're in a low season here, what do we actually see? Can anyone sort of identify what might kind of themes or patterns might be just a little bit clearer as we look at that, okay, and start to identify and understand the themes about low seasons and high seasons, okay, and the sort of elements of seasonality overall in the particular charts? So hopefully what you can start to see is that in the last example of pound against US dollar, you should have noticed that those markets were trending during the high season and ranging during the low season. Okay, if this was a currency, if there was an FX pair you're trading, do you think that would be useful to know this kind of information? Do you think that would help you in deciding where you want to focus your particular time and energy during those periods of the year? Michaela says yes. That's great. It's a good answer. And it's the right answer, Michaela. The answer, of course, should be a clearly yes, right? And it helps to understand the market you're trading before you can successfully implement a trading strategy, understanding what particular season that you might find itself in. Because, and here's just a little bit of an idea, is that what you start to understand is that, well, you start to be able to sort of have a look at what we call like a volatility table, understanding, okay, where that particular market is operating, whether it be an FX or a stock market. So in low seasons, okay, well, we might also be trading into what we call dead zones. There's not particularly anything happening, in which case what you'd be looking to focus on would be things like range trades, okay, fading trades, okay, fake breaks, false breakouts, slow moves. That would kind of sort of start to temper the way you would particularly look to sort of apply your trading tactics during that period. Alternatively, okay, during high seasons, what you'll see is that there'll be particular active zones, active periods during those high seasons, where what we start to see are things like good trends, where we see momentum moves, okay, where we see breakouts that actually break out and follow through. And you actually get to see fast moves, okay, markets break out and they'll make a fast particular move. And that can also be very helpful in trying to understand what kind of particular tactics you might want to look to employ within the particular season once you start to identify and understand where those particular trends and themes may be. So seasonality can definitely play a part in a currency's volatility. And it's important to learn to study these currencies you are trading. And so as an exercise to take away for yourself, ladies and gentlemen, is, take any particular currency you intend to trade and separate the seasons like I did in that example on pound against dollar, and just look back over the last 2 years worth, pick, maybe your particular favorite trading currency and actually start to see, is there a particular seasons there? Okay. Have a look at maybe the stock market, maybe this particular stock that you like, and have a look and see, over the last 2 years, has that sort of replicated that kind of similar idea? Has there been low seasons in that stock? Maybe have there been high seasons? All right. Just particular takeaway and just look at it. Just, it might well be a particular instrument that you like to trade, or maybe just pick one at random, okay, and just practice just looking and doing that and understanding, were the particular low seasons, high seasons, do they kind of come in as we were sort of talking about there, low seasons between, let's say, May and September, and September and April being a high season, because those, if you can start to identify, and there are a little bit of differentiations for FX pairs, but also for particular stocks, well, that can be great information to give you a little bit of a help and understanding in terms of how you particularly wish to focus. If you particularly want to be a trend trader, well, then, you might wish to focus on trading trends during high seasons in particular FX markets. If you yourself prefer to trade false breakouts, you prefer to trade ranges, well, then you might be looking at kind of low seasons in either FX pairs or particular stock pairs where price might see just bouncing in a particular range. Just being able to sort of just take that bigger picture view and, as I said, start to boil down can start to help you identify where you particularly may wish to focus for that particular next time window. So what can you do for trading strategies for low seasons? Well, when you're trading in the low season, you must understand that you can trade trends, but you should be aware of key support resistance levels on higher timeframes, as the market is likely to falter at those particular places. You must also recognize that there is also a good chance that the market will fall into a range or a period of consolidation. Just to be aware of these things, they help you, they help build a picture for good traders to understand where they should be applying their focus and resources. The high season tends to provide longer trends, all right? And you can use similar methods, but you're less worried about the general market direction, as kind of trends tend to be a little bit clearer. But what's also clear is that it's more risky to trade against the major trend during the high season, as those kind of major dominant trends, they tend to last longer. The key difference between high season and low season is the length of the trend. You must be aware of the possible reversal points during the low season, because they're likely to falter there. The high season will often consolidate, but then continue in the same direction. And if you can just take on board those observations into your own trading, okay, whether you're either trading FX or stock markets, you can start to sort of build a bit of a picture and understanding of where and when you can apply, okay, the particular tactics and what you should expect for your particular trades. What it also might be interesting, and this is a personal opinion, is that, if it's an FX low season, it may be the opportunity to look at trading stocks. However, and this is, part two, is it might be easier to begin by looking at equity indices to begin with. Okay. Why? Well, one, it's less instruments to follow, so you're unlikely to get overwhelmed by the huge amounts of thousands and thousands and thousands of different stocks. There is also great research and great analysis available for the major equity indices. And they provide good trading conditions. They're liquid, they're cheap, and they're volatile enough. So in part two, what we'll do is I'll look at that, okay? Forex, stocks, equity indices. That might just be, if you're a complete beginner, that might just be an easier place to begin with. If you are a little bit, let's say, overwhelmed by the sheer number of stocks that are out there for you to be able to trade. So in conclusion, ladies and gentlemen, There are times of the year when it's more focused on either the FX or the stock market. Sometimes this will be very clear, other times it is not. Okay, welcome to trading. But if it isn't clear to you, that's okay. Don't beat yourself up. Stocks tend to require a narrower focus from traders, whereas FX generally tends to require a wider macroeconomic focus. It's helpful to use historical seasonality patterns to give you an edge in your market analysis. Just be aware every currency acts differently, so you must be aware of your chosen market's behavior. Learn to observe and learn from historical moves as they often repeat. Choosing which one to focus on will be based on your experience, your lifestyle, and your goals. So why don't we have a little look on live markets, ladies and gentlemen, for the last few minutes here. Before that, we appreciate that traders want support, okay, and you can get that from the exclusive Trading Spotlight community. So opportunity to go and join us there. I'm going to be there for the rest of the afternoon to answer your trading questions. You'll also find my colleagues Marcus and Jens are posting great stuff every day, and you can join us at tradersyard.com/group/312. Don't forget to join us next time, where you can find my colleague Marcus is going to talk about currency correlation, including defining correlations. Correlations do change, and how to use that to trading Forex. That's going to be on this Wednesday, November 4th. Check your inbox for the webinar link or go across to the Admiral Markets website. You'll find plenty of analysis and education and further resources on admiralmarkets.com. If you want to contact us, you can do email global@admiralmarkets.com, or you can contact us on youtube.com/admiralmarkets, where you'll be able to see this video and all the rest of the Trading Spotlight videos, and also facebook.com/admiralmarketsglobal. I hope you found this useful, ladies and gentlemen. Just give you a little bit of color, a little bit of insight into FX and stock markets. We've got a couple of minutes left, so if you'll bear with me, I'll just switch across to the charts and we'll have a little look at those for just the final couple of moments. So I'm hoping that you can still sort of hear me, see me. Hopefully you can see the charts there, okay? And Opera asks, what is your preferable instrument to trade, whether it be currency pairs or indices? It's a good question. This is a personal thing. I prefer to focus on FX pairs because I know myself, all right? I'm a big picture guy, all right? I'm in MBTI scores. I am a ENTJ, okay? The commander, the field commander. That's, I think, the nickname. I'm a big picture guy. So the macroeconomics element of looking at FX markets on a big picture, that suits me. So I know myself and I bring that into my trading. And when they're aligned, that tends to work well. There will be other people who will look at this and who are very intricate, detailed people. And you know what? Trading stocks might be better for them because they want to focus on one particular stock and go very deep, okay, in their particular focus, whereas I prefer to go wide. Hope that helps you there, Opera there, okay? So what I have here, this is the Admiral Markets MT4 demo platform. And what I have is, I have a profile set up for equities, and I like to look at this for a lot of the big major US stocks that are effectively here for you to trade using the Admiral Markets platform. So I've got Facebook, Apple, Amazon, Tesla, Google, Netflix, Deutsche Bank, and Boeing. Okay, and there are others there you'll find there in the market view you can choose, but these are just some of the big major ones that I like to keep a particular eye on. They are a lot of them are the big major tech companies, which we talked about, US tech stocks. If you are going to trade them, you get lots of volatility, liquidity tends to be pretty good, okay, and you get lots of great research analysis, okay. So there's an awful lot of people trading them. So what you tend to find is that the kind of the sort of skills, okay, and the tactics that I like to use in FX markets, I find work just as well for me, okay, within stock markets and within indices markets, okay. I personally tend to prefer on having just some simple, robust tactics that I can see and employ across the board. That's what works for me. I tend to sort of see patterns and trade those patterns. Other people will be very different, okay, and that's okay. That's okay. Part of it is about understanding what works for you. I find simple patterns that I can see repeating time and time and time again across, whether it's euro, dollar, Amazon, gold, Bitcoin. That suits me. Okay, that suits me. I have a couple of patterns. Bosh. I like to see them. I like to trade them. That's what works for me. Everybody is very, very different. Some of you might look at stocks for the first time and might not be able to understand it. But really, what we're looking at is, let's have a look at Amazon on the weekly chart here. Look at this. This is just, remember what I'm saying is that, we look at here for 2020. That has just been a great trend, hasn't it, ladies and gentlemen? Remember what I was saying? Sometimes it's very clear what you want to be trading. And when there's just great trends like that, that's what you want to be part of, okay? When it's very clear, that's it. When it's not clear, well, maybe you sit away. But looking at Amazon there, I look at that as that's a double top pattern there, okay? It's a 1, 2, 3 double top pattern there. And I start to think of, okay, all right, my plan would be, well, does it break this particular level? That could be a sell. Or does it come down here and then pop up again? Whoops, to make a kind of a head and shoulders pattern. As always, ladies and gentlemen, I'm a better trader than I am an artist, so I apologize, okay? But hopefully you get the picture there. But I find just simple ideas, okay? If there's a good trend, that might provide you with an opportunity to trade with that trend in the stock market, okay? Or there's a very clear, reversal pattern that is coming up, because we have been in the low season, okay, from the summer, okay, May to September. We've been in a bit of a low season. Market has basically been congested, it's rolling around. We've got the US election this week. That might make a difference. And then we might start to see, once that election's up, well then, could we get a high season new trend in the way down? We shall see. We'll find out more over the next week or two. So apologies, ladies and gentlemen, we've run out of time. As always, as I say, we could talk about this for the rest of the week quite happily. But I hope you found that useful. I hope it's given you just a little bit of insight into the FX and the stock market and which one might be more suitable for yourself. As always, I wish you the very best of success in your own trading, and I look forward to speaking to you next Monday when we're back to talk about another great trading topic. And for those who want to join me, I'll be in the Trading Spotlight page on Traders Yard for the rest of the afternoon and during the week. So you're very welcome to come and join us and have a chat about your own particular trading challenges. Until that time, trade well, ladies and gentlemen, and I'll speak to you soon. Many thanks.